Hello everyone, you're listening to Gold for Career, your personal finance and personal growth podcast. Thanks for tuning in. In today's podcast, you'll learn about what exactly an IRA is, as well as a Roth IRA, and why the Roth IRA is the best choice for your lifetime retirement plan. Okay, so what is an IRA? An IRA or individual retirement account is simply a tax-advantaged account designed for long-term growth. Contrary to 401ks, these are not employer-offered plans, they are plans offered by financial institutions. They are the best alternative in case your employer doesn't offer you a 401k, since you can always apply for an IRA. If you do already have a 401k, you can always diversify and put money into a Roth IRA because of its many advantages. There are two types of IRAs, a traditional IRA and a Roth IRA. The difference lies on when you want to pay taxes, in the present or in retirement. A traditional IRA allows you to put your before-taxed money into the account, which means that you won't pay taxes for all the money deposited in the investment plan. However, upon retirement, you are taxed on all the growth generated in the investment, which doesn't sound so attractive since taxes may be as high as 30%. On the other hand, in a Roth IRA, you're placing your after-tax money into the account. In that way, you won't be taxed upon retirement on the growth generated. Roth basically means that you're putting money that's already taxed, also known as post-tax money. If you had to choose between a traditional and a Roth IRA, you should choose a Roth IRA without hesitation, since you can potentially save hundreds of thousands in your retirement because you aren't taxed on the growth of the investment. Investing your Roth IRA money in a market investment plan can average around a 7 to 8% rate return over the long term. Currently, you can contribute $6,000 every year or $7,000 if you're over 50 years old to your IRA. It's important to open your IRA as soon as possible, since the sooner you open one and the younger you are, the greater your lifetime savings will be due to the tax-free compound interest in which your money grows within an IRA. Upon retirement, you will be eligible for the withdrawal of the investment plan earnings through what are known as distributions, which of course will be tax-free. However, there are some limits for being eligible to tax-free returns on a Roth IRA. Your annual gross income, that is your overall income before tax, and all your deductions added as well, must be less than $140,000 per year if filing taxes single, and less than $206,000 if married and filing taxes jointly. These figures may slightly increase or decrease every year, but they are normally around that range. Anyone with earnings above these figures cannot contribute to Roth IRA accounts, only to traditional IRAs. It's important to know that common retirement plans such as traditional IRAs, 401ks, and Roth 401ks do not allow tax-free or penalty-free withdrawals until retirement, which may take several decades depending on your age. However, in a Roth IRA, since you are contributing after-tax money, contributions can be withdrawn at any time completely tax-free and penalty-free 5 years after your first contribution. That in itself is a huge bonus compared to other retirement plans. And once you have reached the age of 59 and a half, earning withdrawals from the investment are tax-free as well. This gives the user higher liquidity, since after 5 years, a Roth IRA almost acts like your typical savings account, since there are no penalties for withdrawing your deposits. But of course, that's not what it's meant for. It's not a good idea to deposit money into your Roth IRA that you're later going to withdraw, since you'll be missing on the growth of the investment. Always deposit consistently every month and try to withdraw money only in the case of an absolute emergency. But for that, you should already have a separate bank account with money saved up for emergencies. And if you don't already have that, apart from your general savings account, you should create one now. In your individual retirement account, you really need to let your savings alone to let them grow over time. It's not worth opening one if you're later going to withdraw money out of it. Okay, so when you finally reach your annual contribution of $6,000, the current maximum annual contribution if you're under 50, if you decide to withdraw some money once you've completed your annual contribution before the end of the year, thinking that you can later deposit it back, recontributing that same amount within the same fiscal year will not have fiscal advantages. It basically won't be considered as a tax-free contribution, and you'll have to pay taxes on the growth of that money upon retirement. This is quite crucial information because once you deposit a certain amount, if you withdraw it and later decide to deposit that same amount, this money won't be considered for the Roth IRA tax-free return. That is why it's not always best to deposit all your money as soon as possible and have your annual contributions met after, for example, 10 months. Since that might reduce your liquidity and you'll end up having to withdraw some of the money because you realize that you actually needed that money for something else, or some kind of unexpected expense suddenly popped up in your life. So you'll end up withdrawing the money that is tax-free upon retirement, thinking that you will always be able to deposit it back at the end of the month. Unfortunately, it doesn't work like that. Apart from not being able to recontribute money back for tax-free advantages, you also need to consider the withdrawal penalty if you haven't held your Roth IRA for at least 5 years. That is why you should always deposit your savings every month and not get ahead of yourself. Your goal should be aiming to maximize your annual contribution so that your money grows maximum in value every year. You need to make sure you have the sufficient funds available before depositing. If you can't maximize your contributions every year, don't try to do it, since you may incur in unnecessary penalties and further headaches withdrawing money from your Roth IRA. If you are unemployed and get small earnings from different kinds of sources, but you barely have enough to reach the end of the month, it doesn't make sense to start opening a retirement savings account or investing in anything. In that case, you should be focusing on getting a job. If you currently have a job and a somewhat stable salary and still barely reach the end of the month with your current salary, you should work on tracking your expenses and on reducing some of the unnecessary expenses. You might not be conscious of your expenses if you don't have a quick and visual photo of them. Whether we are conscious of it or not, we all have unnecessary expenses that can be mitigated or even eliminated. I've left a link to a free budgeting sheet in the description so you don't have to make one. If you don't already track your expenses, please download it and start doing it now, as it is the best way to track your expenses and only takes a few minutes of your time per day. Another thing that you should take note of is that on average, the older you get, the higher the tax bracket you'll be in, contrary to the popular belief of it being the opposite way. This further proves that a Roth IRA is the best choice, since you'll be paying lower taxes on your income in the present and you'll be able to withdraw funds tax-free in retirement. And if you are in a lower tax bracket in your later years, it doesn't really matter. You'll still be eligible for tax-free returns upon retirement. Financial education normally focuses on the no risk, no reward belief. However, investing your Roth IRA savings into a good investment plan that focuses on market growth could actually be considered as low risk, high reward. Since you're investing in the long term without focusing on technical stock analysis, intraday trading, or any of that sort of speculative trading, you are investing in the market over the long term without focusing on market highs or market downs, just an average market return of 7 to 8%, inflation adjusted and with dividend growth reinvested. Depositing every month without any effort put into investigating the market, researching the most profitable stocks or any of that sort of thing. Just focus on investing in a market index that comprises of hundreds of different companies, a completely diversified investment, reinvesting dividend growth in the same account as well. The longer you keep your money and keep investing, the higher the odds of overcoming any market downs, since the market has a growing trend. There will always be recessions and booms. Just don't panic in a recession and withdraw all of your investments. Learn to live with the market cycle and don't be emotionally scarred seeing red numbers everywhere. It actually doesn't matter, since you're expected to withdraw your money in retirement, which can take several decades, not a few years. Let's assume that you are 25 years old, expecting to retire at 65 years old, and decide to open a traditional IRA instead of a Roth, making an initial investment of $1,000, and you decide to contribute $500 pre-tax dollars every month to reach the maximum annual contribution of $6,000. Considering an annual rate of return of 7% and an inflation rate of 2%, you will retire with around $1.2 million. However, since it's a traditional IRA, you will have to pay taxes on that $1.2 million since it's pre-tax dollars. Assuming that your marginal tax rate is 30% at the age of retirement, you will have to pay the government $360,000 in tax, and you'll end up with $840,000. However, if you had chosen to open a Roth IRA, investing $500 post-tax dollars every month until retirement, you would not have to pay the $360 in tax, meaning that you will end up with $1.2 million completely tax-free. All the market growth and continuous investing every month eventually rewards you with over $1 million in retirement. Your investment gains grow exponentially over time as you deposit money monthly, reinvesting dividends and letting the market grow. Another way to think of it is that your money is creating more money, and that more money is creating even more money, 24 hours a day, 7 days a week, even while you sleep. Moreover, there are absolutely no age limits in Roth IRAs, unlike other retirement plans. There's no required minimum distribution once you retire. You can withdraw any amount of your total investment at any time. The only requisite you must fulfill is having an earned income in order to be eligible for a Roth IRA. A 9-year-old who makes $2,000 during a tax year selling lemonade on the streets can contribute that same $2,000 to his Roth IRA account. The only downside, if any, is that the annual contribution of a Roth IRA is only $6,000 in comparison to the $19,000 annual contribution of a Roth 401k, an employer-offered retirement plan. That is why it's optimal to combine your Roth IRA with a Roth 401k, especially a Roth 401k with employer matching. If you want to know more about that, check out my podcast episode 2 about Roth 401ks. Okay, so let's do a quick recap of this episode. There are two types of IRAs, a traditional one that uses pre-tax money and later is taxed upon retirement, and a Roth IRA that uses post-tax money and is tax-free upon retirement. A Roth IRA is your best choice since all your investment growth can be withdrawn completely tax-free upon retirement, potentially saving you hundreds of thousands of dollars. Currently, you can contribute $6,000 every year into your Roth IRA if you're under 50 and $7,000 if you're over 50. To be eligible for a Roth IRA, your gross income with deductions added must be less than $140,000 if single and $206,000 if married. Contrary to other retirement plans, a Roth IRA allows for penalty-free withdrawals of your contributions after 5 years, as well as penalty-free earning withdrawals after the age of 59 and a half. Focus on maximizing the $6,000 annual contribution, depositing $500 every month. Never withdraw money from your Roth IRA to later recontribute it back, since that money will not be considered tax-free. You can combine your Roth IRA with a Roth 401k if your employer offers you one. Share this podcast with your friends and loved ones that also wish to retire millionaires. If this content helped you to clear things up, please give it a like or follow, as it greatly helps me to keep producing content for you guys. And as always, thanks for listening.